Inflation doesn't arrive with sirens or headlines that scream danger, yet it quietly reaches into your wallet and reshapes your future without asking permission. Most people assume inflation is just about paying more for groceries or gas today, but that belief hides a deeper truth that almost no one talks about. What if the real damage of inflation shows up decades later, when it's too late to fix? What if the biggest thing inflation steals isn't money, but time, opportunity, and security? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand why inflation is so dangerous to your future, we need to rewind the clock and look at how money itself came to work the way it does. For most of human history, money was tied to something tangible like gold, silver, or land. Prices moved slowly, sometimes barely changing over generations. Your grandparents could plan their lives assuming tomorrow would look a lot like today. That stability shaped behavior, savings habits, and even family decisions. Then modern financial systems changed the rules, quietly and permanently. The big shift happened when governments learned they could print money without immediately feeling the pain. During wars, recessions, and political crises, printing money felt like an easy fix. At first, it worked. Economies restarted, jobs returned, and growth appeared. But every new dollar reduced the value of the dollars already in circulation. That erosion didn't show up overnight, so most people didn't notice. Inflation became a slow leak instead of a sudden explosion, and slow leaks are the hardest to detect. Here's where the story starts getting uncomfortable. Inflation is not evenly shared. It doesn't hit everyone the same way at the same time. Asset owners often benefit early, while wage earners feel the pain later. If you own property, stocks, or businesses decades ago, inflation may have made you richer on paper. If you relied mostly on wages and savings, inflation quietly pushed you backward. This unequal impact is one reason inflation keeps repeating across history. Imagine someone in the 1970s earning a decent salary and saving responsibly. Inflation surged, interest rates spiked, and prices climbed faster than wages. Even though this person did everything right, their purchasing power collapsed, retirement plans shrank, dreams were delayed or abandoned. This wasn't bad luck. It was a predictable outcome of a system that slowly devalues money over time. The scary part is that many people today are unknowingly repeating this exact scenario. Now let's talk about compounding, because this is where inflation becomes truly destructive. People love to talk about compound interest when investing, but inflation compounds too. A 3% inflation rate doesn't mean prices rise 3% once. It means prices rise 3% this year, then 3% on top of that next year, and again the year after. Over 30 years, that seemingly small number can cut your purchasing power in half. Here's a simple example that feels harmless at first. If something costs $1,000 today, and inflation averages 3%, that same thing could cost over $2,400 in 30 years. Your salary may increase, but history shows wages often lag behind inflation. Housing is where inflation leaves one of its deepest scars. Decades ago, a single income could support a family and buy a home. Today, housing prices have outpaced wages dramatically in many areas. Inflation plays a major role here, not just through higher prices, but through cheap money and easy credit. Low interest rates push asset prices up, making homes harder to afford for first-time buyers. The door closes slowly, then suddenly. Education tells a similar story. Tuition costs have exploded far beyond general inflation. Students borrow more, graduate with heavier debt, and start adult life already behind. Inflation doesn't just raise tuition, it inflates the cost of mistakes. A wrong degree choice today can haunt someone for decades because the financial burden compounds. Healthcare costs reveal another hidden layer. Medical expenses tend to rise faster than overall inflation. Insurance premiums increase, out-of-pocket costs climb, and savings meant for the future get diverted to survival. Inflation makes emergencies more expensive and planning less reliable. The older you get, the more exposed you become. This is one reason inflation hurts retirees disproportionately, even though they no longer earn wages. At this point, you might be thinking inflation is inevitable, so why worry? That's exactly the mindset that allows it to do the most damage. Inflation isn't just an economic force, it's a behavioral one. It changes how people think about money. When people expect prices to rise, they rush purchases, avoid saving, and take on more debt. Those behaviors feed inflation further, creating a self-reinforcing loop that's incredibly hard to break. Raising interest rates can slow inflation, but also trigger recessions and job losses. Lowering rates can boost growth but inflate bubbles. History shows there's no painless solution once inflation takes hold. Every fix comes with trade-offs, and those trade-offs often land hardest on everyday people. One of the biggest myths is that cash is safe. It feels safe because the number doesn't change. But inflation ensures that cash quietly loses value every year. Keeping money under a mattress or in a low-interest account can be riskier than investing, even if it feels conservative. The risk isn't volatility, it's erosion. And erosion works slowly enough that most people don't react until significant damage is already done. Consider retirement planning. Many people calculate how much they'll need based on today's expenses. That's a dangerous shortcut. A comfortable lifestyle costing $50,000 per year today might require $100,000 or more decades from now. Inflation turns underestimations into crises. People reach retirement age and realize their savings can't support the life they imagined, forcing painful compromises. Social security systems were designed in a different era, under different assumptions. Inflation strains these systems by increasing payouts while reducing the real value of contributions. Governments respond by raising retirement ages or adjusting benefits. Individuals feel betrayed, but the math was always unforgiving. Inflation exposes promises that were politically convenient but financially fragile from the start. Debt behaves strangely during inflation, and this is where things get confusing. Inflation can reduce the real value of fixed-rate debt, which sounds good. But lenders respond by raising rates, tightening credit, and increasing costs elsewhere. For consumers, this often means higher monthly payments, stricter approval standards, and fewer opportunities. What looks like relief in one area becomes pressure in another. The stock market adds another layer of complexity. Stocks often rise during inflationary periods, but not always in a way that protects purchasing power. Nominal gains can hide real losses. An investment that grows 5% in a year with 6% inflation actually makes you poorer. This illusion keeps many investors complacent, celebrating gains that don't truly improve their future. History is filled with inflationary warnings. From ancient Rome diluting its coins to more recent examples like the 1970s, the pattern repeats. Governments overspend, currencies weaken, prices rise, and trust erodes. Each time, people believe this time is different. Each time, the math proves otherwise. Inflation doesn't care about optimism, politics, or good intentions. The breaking point often comes when confidence collapses. People stop trusting money itself. They rush into hard assets, foreign currencies, or speculative investments. Volatility increases, inequality widens, and social tension grows. Understanding this helps explain why financial stability is tied so closely to political and social stability. Modern economies are juggling high debt, aging populations, and complex global systems. Inflation pressures haven't disappeared, they've evolved. Technology may lower some costs, but it doesn't eliminate monetary realities. The same forces that shaped past inflation cycles are still at work, just in more sophisticated forms. Here's the part most people miss: inflation isn't a single event. It's a long story unfolding over your lifetime. Ignoring it doesn't make it go away. It just guarantees you'll feel its impact later, when flexibility is lower and options are fewer. Think about your future self. The decisions you make today about saving, investing, and spending are being filtered through inflation whether you acknowledge it or not. Every year you delay learning how inflation works, the cost of ignorance compounds. This isn't meant to scare you, it's meant to wake you up before the quiet damage becomes irreversible. The good news is that awareness creates leverage. You can focus on growing purchasing power, not just account balances. You can question assumptions, adjust strategies, and avoid common traps that catch people off guard decades later. As we wrap up, here are 3 takeaways to remember. First, inflation is a long-term force that compounds quietly and relentlessly. Second, ignoring inflation is riskier than confronting it, especially when planning for the future. Third, understanding how inflation affects different areas of life gives you the power to adapt rather than fall behind. The warning is simple: the future costs more than you think. The open question is whether you'll prepare for it now or pay for it later. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.